Big day today. So today was the Fed meeting, and we got to hear from Jerome Powell, who over the past 6 months, 12 months, even past 18 months, has been pretty hawkish towards interest rates. What that means, he's been pretty aggressive towards hiking interest rates. Well, for the first time, he actually was dovish, which essentially signals that the Fed is looking for lower interest rates in the future. So let's go over a few things that he talked about today. He once again admitted that we are at the end of our rate hike cycle and that the Fed will be looking to lower interest rates this year. They still need to see inflation coming down more, and we know inflation's been sticky, right? And they've been saying that over and over. We've had 2 consecutive negative or poor prints from inflation. We were expecting better prints. So inflation currently stands at 3.2. We know the Fed target is 2%. So that's where that sticky headline is. How do we get to 2? And we fully expect the next 3 to 4 months inflation to continue to print about 0.2, 0.3 month over months, meaning that these headline targets will still be between 3 to 3.3%, which again isn't that 2% number. So we were worried that the Fed was going to come out and say that, hey, inflation is a problem. We are seeing it and we are just not going down low enough. Thus, we may need to actually prolong these rate hike cycles, and we may need to actually even hike interest rates again, but they didn't. They actually came out and said that they were expecting inflation to come in high the first 6 months of the year, and they expect inflation to start to slow down in the back half of the year. I was not expecting that, so that was a great comment. Then they were hounded with labor market data because we continue to see that labor has been slowing down. The unemployment rate is up to 3.9%. Their target this year was only 4%, so we're already almost there. We can see job openings coming down. We can see employees staying at their job longer, right? We can see all of this. We can see the labor market slowing down, and the Fed has that dual mandate, inflation and labor. And they highlighted several times today that if they see the labor market continue to slow down, they may need to start cutting interest rates. So what we have and what we look for is the Fed dot plot. The Fed dot plot basically takes all the Fed chairmen and they predict where interest rates will be at specific periods of time. So in June, in July, in August, in December, where they think interest rates will be. So as of right now, they're still predicting 3 rate cuts this year. And that's what they were actually projecting in December as well. The market was just more optimistic. The market was predicting 7 rate cuts this year. So the market was wrong. The Fed hasn't changed. The Fed has been simple, 3 rate cuts. So the first rate cut looks to be about June. And again, we were worried coming in that after this pretty poor inflation prints that they were going to come in, they were going to say, hey, maybe it won't even be 3 rate cuts, maybe it'll be 1. But we didn't get that. We got this great tone, great sentiment from him, again, pointing that we are at the end of this cycle. Still not quite there. Interest rates are still elevated, especially from a historical standpoint, but we can see that the Fed wants to bring them down. We can see that interest rates will be coming down, whether it's Q3 or Q4 or even 2025. At least it's more promising signs ahead from the interest rate perspective.